Welcome to our deep dive on credit risk transfer mechanisms. I'm really excited to unpack this topic. It gets to the heart of how financial institutions manage risk, and frankly, it's a bit of a mystery,
Yeah.
to most people outside the world of finance.
Yeah, it's true. These mechanisms operate largely behind the scenes, but they have a huge impact on the stability and the efficiency of the entire financial system.
Right, so let's break it down. We're talking about the tools and strategies that institutions use to deal with the possibility that borrowers might not repay their obligations. And it's not just for banks, is it?
Not at all. We're talking about a wide range of players, from insurance companies to investment funds, even governments, all using these mechanisms to navigate the complex world of credit risk.
Okay, so where do we even begin with something this broad?
Well, it's helpful to think about it in layers, starting with the more traditional approaches to credit risk management. These are the foundations, if you will.
All right, let's lay that foundation then. What are we talking about here?
Traditionally, banks have four main options when dealing with credit risk: accepting it, avoiding it, reducing it, or transferring it.
Makes sense.
Yeah,
But for this deep dive, we're really focusing on that last option, transferring the risk right.
absolutely. That's where these specialized credit risk transfer mechanisms come in. They provide ways to shift that potential burden of loss to other parties.
So before we get into the more complex stuff,
Mm,
can you give us some examples of those traditional ways to transfer risk?
sure. Insurance is probably the most familiar example. You pay a premium to an insurance company, and they agree to cover your losses if a specific event happens. Like a borrower defaulting on a loan, it's a classic way to offload risk.
Right, like insuring your car or your house.
Mhm.
But in this case, you're insuring against financial loss.
Exactly.
Mhm.
And another traditional technique is called netting. It's basically a way for two parties to simplify their obligations to each other by offsetting the amounts they owe. Let's say you and I both have outstanding invoices with each other. Instead of each of us making separate payments, we can net those amounts against each other and just settle the difference.
So it's about streamlining those financial relationships and reducing the potential exposure on both sides.
Precisely. But these traditional methods have their limitations, especially when dealing with more complex financial transactions. And that's where credit derivatives come in.
Ah, credit derivatives. Now we're getting into the territory that's a bit more mysterious,
Yeah.
even a little bit intimidating, to be honest.
I understand. It's a world of specialized financial instruments that can seem very abstract, but at their core, they're designed to do one thing: transfer credit risk without transferring the underlying asset.
Okay, let's unpack that. So instead of actually selling a loan or a bond, you're essentially creating a separate contract that deals specifically with the risk associated with that asset.
Exactly. Think of it like this. Imagine you own a beautiful antique vase, but you're worried about it breaking. You could sell the vase to someone else and eliminate the risk entirely, but then you wouldn't get to enjoy it anymore. A credit derivative is like buying insurance on that vase. You keep the vase,
Uh,
but you transfer the financial risk of it breaking to the insurance company.
that's a really helpful analogy. You get to keep the asset,
Yeah.
but you're shifting the potential burden of loss to someone else.
Exactly. And these contracts are typically negotiated privately, often over the counter, which means they're not traded on public exchanges. This gives them a lot of flexibility, but also introduces a certain level of complexity.
And that lack of transparency was a big part of the problem during the 2007-2009 financial crisis, right?
You're absolutely right. The misuse of credit derivatives, particularly a type called collateralized debt obligations, played a significant role in that crisis. But it's important to remember that the instruments themselves aren't inherently bad. Like any tool, they can be used responsibly or irresponsibly.
Okay, so it's not about demonizing these tools,
Hmm.
but about understanding how they work and the potential risks and benefits they bring to the table.
Exactly. So let's dive into some of the specific types of credit derivatives. Would you like to hear a list?
Absolutely. Let's get familiar with the key players in this arena.
The main ones to know are credit default swaps, CDSs, collateralized debt obligations, CDOs, collateralized loan obligations, CLOs, total return swaps, TRSs, and credit default swap options, CDS options.
Wow, that's quite a lineup.
Yeah,
And each one serves a slightly different purpose, I imagine.
that's right. Each one is tailored to address specific needs and manage different types of credit risk.
All right, let's start with the one that seems to get the most attention, maybe because of its somewhat notorious reputation. Credit default swaps. What exactly is a CDS and how does it work?
A CDS is essentially an insurance contract on a debt obligation. Imagine a company issues bonds to raise capital, and an investor buys those bonds. That investor is now exposed to the risk that the company might default, and fail to make its interest payments or repay the principal.
So that investor could buy a CDS to protect themselves from that potential loss.
Exactly. The investor would enter into a contract with another party, typically a financial institution, and agree to make regular payments, kind of like insurance premiums. In return, the other party promises to compensate the investor if the company defaults on its debt.
So the investor is basically transferring the credit risk of the bond to this other party in exchange for a fee.
Precisely. And the CDS market is massive. Back in 2018, it was valued at trillions of dollars, which shows just how significant these instruments are in the global financial system.
Wow, that's a lot of risk being transferred around.
Hmm.
So CDSs sound like a pretty powerful tool for managing credit risk. What are some of the advantages they offer?
Well, for one, they can act as a shock absorber during financial crises. If a company starts to struggle, investors who hold its bonds, but also have CDS protection, are less likely to panic and sell off their holdings, which can help stabilize the market.
So it's like having a safety net that helps prevent a domino effect of sell-offs and further market instability.
Exactly. CDSs can also increase liquidity in the credit markets. Since investors can more easily hedge their risk using CDSs, they're more willing to buy and sell bonds, which makes the market more active and efficient.
Right. It's like adding oil to the gears of the market, making everything run smoother.
Mm-hmm.
And what about those insights into debtor health you mentioned earlier?
That's another key advantage. The price of a CDS on a particular company's debt can actually reflect the market's perception of that company's creditworthiness. If investors believe the company is in good shape, the price of the CDS will be lower. And if they're worried about default, the price will be higher.
So it's like a real-time barometer of how much confidence the market has in a particular borrower.
Exactly. And that information can be valuable for investors, lenders, and even regulators who are trying to assess risk and make informed decisions. But of course, CDSs also come with potential downsides, some of which we've already touched upon.
Right. And we need to understand those downsides as well to get a complete picture. What are some of the key concerns with CDSs?
Well, as we mentioned earlier, the lack of transparency in the over-the-counter market can create opportunities for manipulation. Imagine a scenario where a hedge fund has taken a large short position on a company's stock, meaning they're betting the stock price will go down. They could then start buying up a lot of CDS protection on that company's debt, driving up the price of the CDS and signaling to the market that there are concerns about the company's creditworthiness.
Essentially creating a self-fulfilling prophecy, right?
Yeah.
They're betting on the company failing and using CDSs to influence market sentiment in a way that might make their bet more likely to pay off.
Exactly. It's a complex game, and the lack of transparency in the CDS market can make it difficult to detect this kind of manipulation. And that brings us to another concern, defining what constitutes a default event.
Oh, right. That can be a tricky one, can it?
Absolutely. Different CDS contracts can have different definitions of what triggers a payout. It might seem straightforward, but in the real world, there can be a lot of gray areas, which can lead to disputes and legal battles. And then there's the issue of counterparty risk.
Right. Just because you have CDS protection doesn't mean you're completely off the hook. What happens if the party that sold you the CDS goes bankrupt themselves?
That's a key risk to consider in that scenario. You might not receive the payout you were counting on, even if the underlying borrower defaults. It highlights the importance of carefully assessing the creditworthiness of the CDS seller, not just the borrower.
So CDSs are powerful tools, but they require a sophisticated understanding of the market and a careful approach to risk management. They can be a valuable part of a well-diversified portfolio, but also a source of potential trouble if misused or misunderstood.
Couldn't have said it better myself. Now, are you ready to move on to the next credit derivative on our list?
Yes, let's tackle collateralized debt obligations next. I feel like I've heard that term thrown around a lot, especially in the context of the financial crisis, but I'm not entirely sure I grasp what they are.
CDOs definitely got a lot of attention during that period, and not always in a positive light. They're complex instruments. But the basic idea is to pool together a bunch of assets like mortgages, corporate bonds, or other loans, and then create different tranches or slices of that pool based on their risk profile.
Okay, so it's kind of like taking a bunch of different loans and grouping them together based on how likely they are to default.
Exactly. You end up with different tiers of risk and return. You have the senior tranche, which is considered the safest because it gets paid first if any of the underlying loans default. Then there's the mezzanine tranche, which is a bit riskier and gets paid second. And finally, you have the subordinate or junior tranche, which is the riskiest, but also offers the potential for the highest returns.
So it's like a layer cake of risk and return,
Yeah.
with the safest slice on top and the riskiest slice at the bottom.
That's a great way to visualize it. And the structure is designed so that if there are some defaults in the underlying pool of loans, the losses are absorbed first by the subordinate tranche holders, then the mezzanine tranche holders, and only if those are completely wiped out would the losses reach the senior tranche holders.
So it's a way to create different levels of investment opportunities within a single pool of assets,
Yeah.
catering to different investor appetites for risk.
That's exactly right. And CDOs, despite their role in the financial crisis, can offer some legitimate benefits. For one, they can help increase the availability of credit in the economy
Oh, so
by pooling assets together and slicing them into these different risk profiles. Banks can attract a wider range of investors, including those who might not be comfortable with the risk of individual loans. This diversification makes the entire structure more appealing and allows banks to free up more capital to lend out to other borrowers.
so it's like they're creating more investment options to attract more capital,
Mhm.
which ultimately leads to more lending and economic activity.
Precisely. And CDOs can also help make illiquid assets like mortgages more liquid by transforming them into tradable securities. This can increase market efficiency and make it easier for investors to manage their portfolios.
Okay, so there's some potential upsides to CDOs, but we also need to talk about those downsides, especially given their role in the 2007-2009 financial crisis. What were some of the key problems that emerged?
One major concern was that CDOs could incentivize relaxed lending standards. If banks knew they could package up even risky loans and sell them off to investors as part of a CDO, they might be less careful about who they lent to.
So it's like passing the hot potato, hoping that someone else will get burned if things go wrong. And that's kind of what happened with subprime mortgages, right?
Unfortunately, yes. Banks were giving out mortgages to borrowers with poor credit histories, knowing they could bundle those risky loans into CDOs and sell them off to investors who were perhaps not fully aware of the underlying risks. When the housing market bubble burst and those subprime mortgages started defaulting, it triggered a chain reaction that spread throughout the financial system.
It's a reminder that even seemingly complex financial instruments are ultimately tied to real-world assets and economic conditions. And when those fundamentals are weak, no amount of financial engineering can hide the underlying problems.
Exactly. And there's another potential downside to CDOs: market freezes. When investors lose confidence in the underlying assets, they become reluctant to buy or sell CDOs, which can lead to a lack of liquidity and make it difficult to determine the true value of these securities.
So it's like a sudden loss of trust in the system,
Yeah,
where everyone's afraid to make a move and the market grinds to a halt.
that's a good analogy. And those market freezes can exacerbate financial crises, making it harder for institutions to raise capital and manage their risk.
Okay, so CDOs are a powerful tool with the potential for both good and bad outcomes. They can be used to increase credit availability and market efficiency, but they also come with inherent risks that need to be carefully managed and understood.
Absolutely. And that brings us to the next type of credit derivative on our list: collateralized loan obligations, or CLOs. Have you heard of these before?
I have, but honestly, they're the ones I understand the least.
That's understandable. They're often lumped together with CDOs because they share a similar structure and function, but there are some key differences. Essentially, a CLO is like a CDO, but instead of pooling together mortgages or bonds, it pools together loans that have been made to companies.
So instead of packaging up home loans or corporate bonds,
Yeah.
they're packaging up loans that companies have taken out to finance their operations.
Exactly. These loans are often referred to as leveraged loans because they're made to companies that already have a significant amount of debt. And like CLOs are then sliced into those different tranches based on their risk profile, with senior tranches offering the most protection and subordinate tranches offering the highest potential return.
Okay, so it's basically the same concept as a CDO, just with a different flavor of debt.
That's a good way to put it. And like CDOs, CLOs can be beneficial in that they can help increase the availability of credit to companies, particularly those that might have difficulty accessing traditional sources of financing. But they also come with the same potential downsides as CDOs, including the risk of relaxed lending standards and the potential for market freezes.
Right, so it's important to apply the same level of scrutiny and risk awareness to CLOs as we do to CDOs.
Absolutely. And that brings us to another interesting credit derivative: total return swaps. These are a bit different from the ones we've discussed so far, as they don't involve pooling assets together.
Okay, so what's the basic idea behind a total return swap? I'm intrigued to hear how this one works.
Imagine a bank has made a large loan to a company, and they want to reduce their risk exposure without actually selling the loan. They could enter into a total return swap, or TRS, with another party, where they agree to pay that party the total return of the loan. which includes both the interest payments and any changes in the loan's value.
So it's like the bank is handing over the keys to the loan, letting the other party experience both the potential gains and losses.
Exactly. In exchange for taking on this risk, the other party makes regular payments to the bank based on a predetermined benchmark, often something like LIBOR plus a spread.
Okay, so the bank gets to remove the loan's risk from its balance sheet, and the other party gets to experience the economic performance of the loan without actually having to buy it. It's a win-win,
Well, wait,
you know.
like well, all these derivatives, it depends on how it's used. And the specific terms of the agreement, TRSs do offer some advantages, particularly for the party that's transferring the risk.
Such as.
For one, it allows them to discreetly remove risk without having to publicly announce a sale of the asset. This can be important for maintaining market confidence and avoiding potential negative perceptions.
So it's like a behind-the-scenes way to manage risk without causing a stir.
Precisely. And for the party receiving the risk, it provides access to the economic exposure of an asset without the burden of actually owning it. This can be particularly appealing to hedge funds and other sophisticated investors who are looking to make targeted bets on specific assets or market sectors.
So it's a tool for customized risk management and targeted investment strategies. But of course, there are also potential risks involved, right? What should we be aware of when it comes to TRSs?
One of the biggest risks is counterparty risk. Just like with CDSs, you're relying on the other party in the swap to fulfill their obligations. If they default or become insolvent, you might not receive the payments you were expecting.
Right. It's all fun and games until someone can't pay up. Any other risks to consider?
Interest rate risk is another factor. Since the payments in a TRS are often tied to a benchmark interest rate, like LIBOR changes in that rate can impact the profitability of the swap for both parties.
So it's like betting on a horse race, where the odds can shift unexpectedly due to external factors.
That's a good analogy. And it highlights the importance of carefully structuring these swaps and understanding the potential impact of interest rate movements.
Okay, so TRSs are another tool in the credit risk transfer toolbox, offering flexibility and customization, but also requiring a careful assessment of counterparty risk and interest rate risk.
Exactly. Now, are you ready for the last type of credit derivative on our list? Credit default swap options.
Sure, let's wrap things up with CDS options. From the name, I'm guessing these have something to do with options contracts. But how do they relate to credit default swaps?
You're right. CDS options are essentially options contracts on CDSs themselves. Remember how a CDS gives the buyer protection against a specific borrower defaulting?
Yes, like an insurance policy on a loan or a bond.
Exactly. Well, a CDS option gives the holder the right, but not the obligation to either buy or sell CDS protection at a specific price on or before a certain date.
So it's like having a rain check on a CDS. You can choose to use it if it starts raining defaults, or you can let it expire if the weather stays clear.
That's a great way to put it. It gives the holder flexibility. And there are two main types of CDS options: payer swaptions and receiver swaptions.
Okay, what's the difference?
A payer swaption gives the holder the right to buy CDS protection, while a receiver swaption gives them the right to sell CDS protection. So a payer swaption would be valuable if you expect the creditworthiness of a borrower to deteriorate, and you want to lock in the ability to buy protection at a predetermined price. On the other hand, a receiver swaption would be valuable if you expect the creditworthiness of a borrower to improve, and you want to lock in the ability to sell protection at a predetermined price.
So it's all about managing expectations and
Yeah.
having the flexibility to either buy or sell protection as the market conditions change.
Exactly. And that wraps up our overview of the main types of credit derivatives. It's a complex landscape, but hopefully this gives you a better understanding of the key players and how they function.
It definitely does.
Yes.
It's amazing how much innovation and complexity there is
Mhm.
in the world of credit risk transfer.
Absolutely. And it's a constantly evolving field with new instruments and strategies emerging all the time. But now let's circle back to some of those traditional risk mitigation techniques we touched on earlier.
Okay, so back to the basics. What are some of the other tools in the credit risk management arsenal?
Well, we've already talked about insurance and netting, but there are a few other important ones to mention. One crucial technique is marking to market, also known as margining. This involves settling gains and losses on a contract daily to prevent the accumulation of large losses that could lead to defaults.
So it's like keeping a running tab on who owes what to whom so things don't spiral out of control.
Precisely. Let's say two parties enter into a contract where one agrees to sell the other 1,000 barrels of oil at a certain price in 3 months. The price of oil fluctuates daily, so marking to market means they settle the gains or losses on that contract each day based on the current market price. This prevents either party from building up a huge unrealized loss that they might not be able to cover if the market moves against them.
That makes a lot of sense.
Hmm.
It's all about managing those daily fluctuations and preventing a situation where one party gets stuck with an unmanageable loss. What else?
Termination clauses are another common risk mitigation tool. These are specific conditions written into contracts that allow one or both parties to back out of the agreement if certain events occur.
Okay, so like an escape hatch if the deal goes sour, what kind of events would trigger these clauses?
They could be anything from a ratings downgrade for the borrower to a breach of contract terms or even macroeconomic events like a recession. For example, if a bank lends money to a company and that company's credit rating is subsequently downgraded, the bank might have a termination clause in the loan agreement that allows them to demand immediate repayment.
So it's all about having a safety net in case things take an unexpected turn smart.
Exactly. It's about proactively managing those potential risks and having a plan in place to mitigate them.
Okay, so we've got insurance netting, marking to market, and termination clauses in our toolkit so far. What else is there?
Finally, we need to talk about securitization. This is a process where assets like loans and receivables are pooled together and then transformed into tradable securities that can be sold to investors.
Ah, securitization. This is one I've heard a lot about,
Yeah.
but I'm not sure I fully understand it.
It's a complex process, but let's break it down. Imagine a bank has a portfolio of mortgage loans. They could decide to pool those loans together and create a new financial instrument backed by those mortgages.
So they're essentially creating a new asset out of a bunch of existing loans.
Exactly. This new asset is then divided into different tranches based on their risk profile, just like with CDOs and CLOs.
Right, so you end up with different levels of investment opportunities based on how much risk investors are willing to take on.
Precisely. And these tranches are then sold to investors in the market. This is where a special purpose vehicle, or SPV, comes into play.
Okay, I've heard that term before, but I'm not entirely sure what it means.
An SPV is basically a separate legal entity that's created specifically for the purpose of holding those securitized assets and issuing the asset-backed securities. It acts as a middleman between the original lender and the investors.
So the bank transfers the loans to the SPV, and the SPV then issues securities backed by those loans to investors.
Exactly. This structure helps insulate the investors from the credit risk of the original lender. They're primarily concerned with the performance of the underlying loans, not the financial health of the bank that originated them.
That makes sense. So what are the advantages of using securitization? Why go through all this trouble?
Well, for investors, it gives them more direct exposure to specific asset classes. For example, an investor who wants to invest in mortgages but doesn't want to buy individual mortgages can buy a mortgage-backed security instead.
So it's about expanding investment opportunities
Yeah.
and providing access to a wider range of assets.
Exactly. And it allows for greater diversification. Investors can spread their risk across different types of assets, different geographic regions, and different borrower profiles.
Makes sense. Any other benefits?
Securitization can also increase liquidity in the market by creating more tradable securities. It also helps banks free up capital, allowing them to make more loans, and potentially stimulating economic growth.
Okay, so there are potential benefits for both investors and lenders, but are there any downsides we need to be aware of?
Of course. One concern is the potential for complexity and a lack of transparency. Securitization can create very intricate financial structures that can be difficult for even sophisticated investors to fully understand.
So there's a risk that investors might not fully grasp the risks they're taking on.
Absolutely. And if the underlying assets start to perform poorly, it can be difficult to determine how those losses will flow through the various tranches of the securitization structure. This lack of transparency can lead to uncertainty and panic in the market.
Right, it's like trying to navigate a maze blindfolded.
That's a good analogy. And another concern is that securitization, if not properly regulated, can lead to a disconnect between the originator of the loans and the ultimate holders of the risk.
So the banks that make the initial loans might be less careful about lending standards if they know they can just package those loans up and sell them off to someone else.
Exactly. It's the hot potato scenario we talked about earlier. And that can create systemic risks for the financial system as a whole.
Okay, so securitization is a powerful tool with the potential to enhance market efficiency and expand access to credit, but it also comes with inherent risks that need to be carefully managed and understood.
Couldn't have summarized it better myself. We've covered a lot of ground today exploring both traditional and more complex approaches to credit risk transfer.
It's been an incredibly insightful journey, and I feel like I have a much better grasp on how these mechanisms work and the impact they have on the financial system.
I'm glad to hear that. It's a complex topic,
Yeah,
but a crucial one to understand in today's interconnected financial world.
absolutely. So to our listener, I hope you're feeling a bit more enlightened about the world of credit risk transfer. We've covered a lot of ground, but this is just the tip of the iceberg.
There's always more to learn, and we encourage you to continue exploring this fascinating and dynamic field.
Now, before we wrap things up, I'd love to get your take on the bigger picture. What are your final thoughts on the role of credit risk transfer mechanisms in the financial system?
Well, I think it's fair to say that these mechanisms are a double-edged sword. They can be incredibly valuable for managing risk-increasing liquidity and making the financial system more efficient. But they can also introduce new complexities and potential vulnerabilities. We've seen how these tools, if misused or misunderstood, can contribute to financial crises.
So it's all about finding the right balance between innovation and risk management.
Exactly. And that requires constant vigilance, both from the institutions using these instruments and from the regulators overseeing the markets.
It's like a game of cat and mouse with regulators trying to keep up with the ever-evolving world of financial engineering.
That's a good way to put it. And the stakes are high. The stability of the entire financial system can be impacted by how effectively credit risk is managed.
So what's the one big question you want our listeners to ponder after this deep dive?
I think the most important question is this: how can we harness the power of these mechanisms while mitigating the potential risks they pose? It's a question that will continue to challenge policymakers, regulators, and financial professionals for years to come.
It's a question that goes to the heart of how we balance innovation, stability,
Mm,
and responsibility in the financial system. And it's a question that each of us, as participants in this system, needs to grapple with.
absolutely. We all have a role to play in ensuring that these tools are used for good, not for ill.
Well said.
Yeah.
And on that note of responsibility, I think it's important to bring this back to our listener and talk about why all of this matters beyond the realm of Wall Street. How do these credit risk transfer mechanisms, all this financial engineering we've been discussing, affect the average person?
That's a great point. It's easy to get lost in the technical details and lose sight of the bigger picture. But the reality is that these mechanisms have a profound impact on our everyday lives.
For example,
Well, think about it this way. When these mechanisms are working well, they make the financial system more efficient and stable. This means that banks and other lenders are better able to assess and manage risk, which allows them to offer loans at more favorable rates.
so it can actually make borrowing money more affordable, whether it's for a mortgage, a car loan, or even a small business loan.
Exactly. And that access to affordable credit is a key driver of economic growth and prosperity. It allows individuals to invest in their homes, their education, and their businesses, which benefits society as a whole.
Right? It's like the circulatory system of the economy,
Yeah.
keeping things flowing and allowing for growth and development.
That's a great analogy. But as we've discussed, these mechanisms can also have negative consequences if they're not used responsibly. When risk is mismanaged or hidden, it can lead to those financial crises that we talked about, which can have devastating effects on individuals, families, and communities.
Right. We all remember the 2008 financial crisis
Yeah.
and the ripple effects it sent throughout the economy,
Hmm.
leading to job losses, foreclosures, and a general sense of uncertainty and fear.
Exactly. So understanding how these mechanisms work, both the potential benefits and the potential risks, is essential for all of us, not just financial professionals. It allows us to be more informed citizens and make better decisions about our own financial lives.
And speaking of informed decisions, you left our listeners with a pretty big question to ponder. At the end of the last episode, how can we harness the power of these credit risk transfer tools while mitigating the risks they pose? Any thoughts on that?
It's a complex question with no easy answers, but I think it comes down to a few key things. First, we need more transparency in these markets, more information readily available to regulators, investors, and even the public can help prevent reckless behavior.
Kind of like shining a light on the dark corners, making it harder for people to hide risky bets.
Exactly. Sunlight is often the best disinfectant. Second, we need smarter regulation, not just reacting after a crisis, but anticipating potential problems and adjusting the rules of the game accordingly.
So more proactive refereeing than reactive penalties.
Precisely. And finally, and perhaps most importantly, we need a culture of responsibility within the financial industry. Financial professionals need to understand that they're not just playing with numbers. They're dealing with real people's lives and livelihoods.
It's about recognizing that the decisions made on trading floors and in boardrooms
Hmm.
have real-world consequences, both positive and negative.
Couldn't have said it better myself. Ultimately, it's about finding that balance between innovation and responsibility, harnessing the power of these financial tools
Hmm.
to promote economic growth and stability while also safeguarding against the risks they can pose.
Well, I think we've given our listener a lot to think about today. From credit default swaps to collateralized debt obligations, we've explored a whole universe of mechanisms for managing credit risk.
We've seen how these instruments can be used for both good and ill, and we've discussed the crucial role of transparency, regulation, and responsibility in shaping the future of this dynamic field.
So to our listener, we hope you've enjoyed this deep dive into the world of credit risk transfer mechanisms. It's a complex topic, but as we've explored today, it's one that touches all of our lives in some way.
Keep asking questions, stay informed, and remember, even though these financial instruments might seem abstract and distant, they ultimately connect to the real world in profound ways.
And on that note, we'll wrap things up here. Until next time, keep learning, keep exploring, and keep diving deep.